Hey traders, this is Blake Morrow with Trader Summit. And for the very first time, I have Mr. Ken Morrison from Morrison on the Markets with us today. How are you doing, Ken? And thanks for joining us today.
I'm doing great, Blake, and thanks for a lot for having me on. It's always fun to talk about commodities, and certainly they've been something of keen interest throughout this last 6 months or so, especially.
Yeah, and you know, it's interesting you say that. As a trader of just several decades or a couple decades myself, I've gone back and forth with my love and hate relationships with commodities, but really over the last, as you pointed out, over the last 6 months or more, they've really come into the limelight. And I have to say to the people that are listening at home, I've followed you on Twitter for probably 8 to 10 years, if I had to guess. It's been a long time. And so I know your work. I know how respected you are in the commodity space. So it's really a pleasure to have you here today. But tell us, why is your focus really on commodities, and how did you become that way?
I've been in some form or fashion of the commodity markets for well over 40 years, going on 50 years. I was hired by Cargill out of college as an undergraduate to be on their grain origination and trading business. I spent the first 18, 19 years of my career with Cargill in various trading positions throughout the United States with Cargill in mostly grain origination, but it also included some time on the corn export desk at Cargill. And in 1996, I was transferred to Singapore, their Southeastern Asian headquarters, to basically launch a grain distribution business throughout Southeast Asia for Cargill. So I was the first of about 50 different people that eventually formed that team in Singapore, where we focus primarily on distributing and selling grain into Indonesia, Malaysia, Thailand, and the Philippines. So that's commodities have been my entire life, and agricultural commodities have been my professional concentration throughout that 40 plus, nearly 50 years.
Wow, that's amazing. And and one of the things that, and I don't know if many people know this, but I know this, and I think it's really interesting, is that you're married to Helene Meisler, and she is such a respected analyst. And I just did an interview with her last week. How did you guys meet in the markets?
We met at Cargill, and she and I moved to Singapore together. And I'm happy to be known as Helene's husband. Actually, that's a great reputation in my books. She's taught me a lot about technical analysis and her discipline, and I, of course, we've enjoyed our years together.
Well, that's awesome. She is a wonderful woman. I truly do respect her. I respect you. So I'm really excited to share with the Trader Summit community what you brought about some ideas of the markets. And then, after we're done, we're going to talk a little bit about Morrison on the markets. But I gotta say that if you're watching Ken, this is your very first time seeing him here. Make sure you give him a thumbs up if you're watching us on YouTube. Subscribe to the channel down below so you don't miss any of this exclusive content from Trader Summit. And Ken, we're gonna get to some of your charts. And the first one that you really brought is you brought the cotton chart. And why is this so important to you as a trader?
I wanted to lead off with this chart because there's been, I would say, two major supply shocks in the agricultural commodity area over the last 6 months. I'll talk about wheat in a moment, but the most recent supply shock has been the cotton market. But as you can see here, cotton has really been in a bull market trend. And I should back up and say that I pay a lot of attention to the 5 and 25-day moving averages when they are aligned and moving together, whether that be moving up or moving down together. But you can see here that the bull market in cotton really was in place from about mid-March and culminating with a peak in mid-May. And so if you stayed long cotton once the 5 and 25 day moving average crossed back in March, you would have basically stayed long until it crossed lower there in late May. Now, of course, because the 25-day moving average is a longer period of time, it took until about the 9th of June, I think, before the 25-day moving average actually started to move lower. And so my philosophy using those moving averages is that once they are aligned and moving in the same direction, they are a very strong signal. Nothing foolproof, nothing works all the time, but I would say this: once that 5 and 25-day moving average crossed to the downside in late May, you would not want to be long, and you might not want to be ready to be short yet. But what I also like about the moving averages is that you'll notice that little counter trend rally after it broke in late May. You'll notice the counter trend rally back to the bottom side of the 25-day moving average. That's another way that I use moving averages a lot. Is moving averages oftentimes provide both support and resistance to market trends, and markets tend to fail or retest support at those moving averages lines. And so you can see about 5 days after that failure at the 25-day moving average, you can see that cotton really began to decelerate and broke the major trend line support at $1.15 a pound there in mid to late June. The other thing I like, though, about this chart is that it began to signal that cotton was bottoming here in late July. Once the market did a little consolidation and tested the 95, 96 area a few times before it actually broke out, it was my feeling that eventually cotton was going to break out. And so once again, you'll see in late July, the 5-day crossed over the 25-day moving average. Now, what I want to talk about now, though, is how the market, in fact, preceded a supply shock news that didn't come until last Friday. And so what we've seen since then, if you'll flip to the next chart, which is the USDA's monthly updated forecast for cotton supply, what happened here was almost unprecedented in that the market was surprised that the harvested acreage was reduced by such a significant amount. 1.4 million acres of harvested cotton was taken out of USDA's forecast simply based on the dry weather that we've known in Texas for quite some time. The Texas cotton conditions really haven't changed very much throughout the period of early July until now. But you know, the market was in a downtrend and nobody was maybe paying as much attention to the weather in Texas as they were to the losses that they were incurring on their cotton that they'd gotten long above $1.15. So again, getting back to the supply shock, out of that 1.4 million acre reduction in harvested acreage, USDA was forced to lower production of cotton, U.S. cotton, by about 1.9 million bales. And as a result of how tight that supply had become, they also were forced to ration exports by 2 million bales, leaving a carryout at the end of next year, which will be July of 2023, of 1.8 million bales. Now, to put that carryout in perspective, we in the commodity world like to talk about ending stocks to the year's usage percentage as a ratio. That level of stocks to usage of 1.8 million bales relative to the usage of 14.3 million bales, we've not seen a stocks to usage that low since 1925. And so clearly the market was shocked and surprised by the degree by which we've taken cotton production out of the prospects. So if you'll flip back to that first chart, cotton chart, you'll notice that we've had a significant rally in part, well, mostly since USDA's report on Friday. But what I like about this chart is the market was telling you, in effect, by breaking out beyond the 97-cent resistance level, the market was essentially telling you that there was a possibility that there would be a positive surprise in the market. And obviously there was indeed a very significant surprise in the market. And so what we have now, of course, is cotton both yesterday and today, after a couple of gap higher and limit closes, yesterday and today have traded back above that 115 level by which it broke down. But to update that chart and to tell you how quickly commodities can change, I just did this chart this morning at about 4 hours ago. The market has since come back and tested the 100-day moving average support at 111. And
Wow.
So it's closed one of those gaps, but it did hold there at 111. I had told my subscribers that I felt that we would come back and test that 100-day moving average level. And I think we'll probably go into a period of consolidation now as the market digests. I'd also want to draw your attention to the volume that traded yesterday down that green bar down below. That's the largest volume since last November in cotton. And so clearly, not only was there a supply shock, but there was significant trade, both new longs and probably short covering people getting out of the market.
So Ken, I bet you when it dipped back down to the 100-day moving average that quick, isn't it amazing how much volatility has been injected in the markets over this last year? Things are happening at a much faster rate, in my experience, in the markets that I focus on. Are you experiencing the same in commodities?
I'm experiencing that across the board, Blake. I tell you, the market, not that long ago, the market would allow you to get in at a decent level, but anymore, it all happens so quickly that it's become frustrating. Actually, it's more difficult to trade, certainly more challenging.
Right. Well, you know, the next chart you brought to us was wheat, and how do you feel about wheat now, and what it's doing currently?
I'm going to look at the hard red winter wheat chart in a moment, but the reason I wanted to bring this particular chart into focus today was, again, based on the supply shock back in late February and early March when Russia attacked Ukraine and eventually shut off the ability to ship grain, wheat and corn from Ukraine. You saw a tremendous explosion in the volume and the price of wheat, but also the participation in an ETF that is backed by wheat futures. And so the basic reason for going back to your question and your point a while ago about how quickly markets respond to these things, you can see the volume just surged in terms of the public, and I do emphasize that people that are trading the ETF for wheat are people without a futures account primarily. And so everybody remembers how much publicity that the wheat market was getting back in the early days of March and when Ukraine was attacked. But obviously the market and this vehicle enable the public to participate in that surge in interest in wheat. But as things tend to go in commodities, they are dynamic. Supply and demand changes, and one thing that changed, two things that have really changed, is wheat prices got to levels that India could become an exporter of wheat for a while, and so that added supply to the market. Some that had been lost are offsetting some of the loss of the Ukrainian wheat. And of course, as it's now known, Russia looks like they will produce a record crop of wheat. And so in commodities, that's why I love it, because they always are in a constant flux of change, and you have to stay on top of that, both fundamentally and technically.
That is interesting. And I, as a currency trader predominantly myself, I tend to focus on some of the macro ideas. And I think the commodities market is very similar, different but similar. You're following what's happening beneath the surface, not just what you see face value as far as price goes.
I've always felt, Blake, that my many years of being in the physical trade, in global trade, really it's somewhat unique in the agricultural commodity area, that someone with so many years of physical origination, including time in Asia, I'm better able to relate to what's going on fundamentally around the world, because it's something that I've had to pay attention to for as long as I've been in the business. So yeah. I think it's been an advantage for me. Yeah.
Yeah, it sure has. So the next wheat chart that you brought, what's the difference between the two wheat charts that you have here?
Well, there really are no differences, because the ETF is backed by wheat futures, and so as you could see, they resemble each other in terms of their patterns. But what I wanted to highlight here, and again, I'm using the moving averages to highlight these things, are two things. Wheat has, even go back to, I think you can go back to December, and wheat had been in an uptrend even prior to the Ukrainian Russian issue, and it remained in an uptrend pretty much throughout until late May. But once again, when the 5 crossed below the 25, it's not a market that you wanted to be long in anymore. Maybe it was too soon to be short, but again, it decelerated rather quickly by the end of June. And so here we are now with the market digesting all the changed fundamentals, including record crops in Russia and so on and so forth. What I like about this chart is that it has now gone through roughly 6 or 7 weeks of sideways consolidation. And what I would also like to highlight here is that we did, for the first time since late May, when the 5 and 25 crossed to the downside, for the first time since then, about 5 days ago, we've seen the 5-day cross above the 25-day. Now, again, it's not yet a valid buy signal, because the 25-day, if you do the day count, you know that 25 days ago, the prices of wheat were higher than they are today. And so that 25-day moving average is still moving down slightly. So it's not yet a bona fide buy signal in my mind, where both the 5 and 25-day are moving together higher. But I want to be watching wheat here with the potential for an upside move. Wheat has been, anybody that's made any money trading wheat over the last 6 or 7 weeks, I take my hat off to them, because it's just been nothing but a chop fest.
Well, it does look like it's building some sort of Wyckoff accumulation type of pattern down here. So, and that before we move on to your next chart, I know you wanted to talk a little bit about crude, but I got to ask you this: in the current environment, a lot of people believe that this inflationary environment is going to be much stickier, in the years ahead. And even though we are seeing inflation come off of its highs, a lot of people, a lot of traders, I think most people feel that inflation is going to be persistently high. So how is that going to translate through the commodities market? Does that have you leaning more to be looking to buy and accumulate at lower levels for most of the commodities you trade?
Like the stock market, I guess I would say the commodity market is a market of commodities. And so you have, and one of the reasons I wanted to contrast between what's going on in cotton with what's going on in wheat is you really have markets that are in different phases. And so I would say it's very difficult for me to build an inflationary case based on what commodities are doing as a whole, but there are going to be spots within commodities, such as cotton is one example, where supply shocks can hold up the value of that commodity for a quite some time, because now we're faced with a situation where we're going to have to rebuild cotton stocks, not only in the U.S. but also in the world, because the U.S. is about 28% of all of the cotton exports in the world, and that's the number one position. That's the number one market share of anybody. And so when you take U.S. stocks of cotton down to that level, it's going to take a while to rebuild those inventories. And so that's an area that's going to be inflationary, but how big is cotton to the bigger scheme of things? Not very much.
Wow.
I see, though, in contrast to that, livestock, both in terms of cattle and in terms of beef cattle and in terms of hogs, supplies have been declining. Supplies of beef have been declining. So I think that's an area where the cost of beef and the cost of pork are going to be relatively high for a while now. And again, it takes several cycles in order to get the cycle of supply going in the different direction. And so it's going to take incentive, price, for producers to add to retain heifers, for example, that will ultimately increase the beef supply. But that's a 2 or 3 year situation, and we've been in decline for a couple of years now. So it's mixed, Blake. It really is. But I would say that's a good segue into oil, because oil is needed to transport all commodities in one form or another, and so the oil market, where products go, is going to be an important determinant of where inflation goes. And one of the things there's two things that I watch, or there's several things I watch in oil, but I didn't even need to know the fundamentals of what's going on in the oil market, because I could look at the spreads between the front month and the back month and know that something was changing in the oil market, and it wasn't positive. And so when the spreads broke down in the September-December oil spread, when they broke down from about 650, I knew that oil, in fact, I posted a chart last week of this chart, and I said, it's very hard to get bullish on oil with spreads doing what they're doing.
And I actually remember seeing that tweet. I probably spend like less than a percent of my day on Twitter, just, kind of perusing. And I did see that tweet. So that's interesting that you're explaining this now.
So spreads is one thing I watch. Now we can go to the crude chart.
And here we go.
I've been saying that oil is likely to spend a lot of time now in the $85 to $95 price range. And one of the reasons that I believe that, not just because there's a lot of support down at $85, but I also see refining margins that have found a level where there's still high demand for products. Refining margins peaked in June at about $63 a barrel. They got down to under $40 in the first few days of August, and they bounced back to about 43 to 44. However, if you break those refining margins down between gasoline and diesel, we've got diesel refining margins back to about $55 a barrel, and about a $24 premium to gasoline refining margins. That tells me that there's still strong demand for refining products. And as long as there's strong demand and strong refining margins, for oil, there's going to be demand for oil. And so those are a couple of reasons, both technically and fundamentally, why I believe 85 is going to prove to be a floor for oil, at least in the interim term. And I think we're going to bounce around between 85 and $95.
Well, that's good. And let me just throw this out here. I've been looking at technicals in crude, and my week ahead video suggested, based on a chart pattern, that we could dip as low as 75. Let's just say I'm right, and it happens. We see a big price decline in crude. Just say it lasts a couple of days and it dips back into the mid to high 70s. Would you be a buyer down there?
I think you'd have to be a buyer down there. Yes.
Okay.
Again, based on what I'm basing my decision, my philosophy on about refining margins,
Sure.
I'd have to see refining margins absolutely break, $40 and look like they're going to 30 before I would get berries on oil. Yeah.
That's good.
I would also say though, Blake, I, as you do, watch the daily sentiment index for oil.
Yeah.
We've got it, I think, last night at 44%. That's the least bullish anybody's been on oil since in December, I think. And so that's not extreme yet. It would not be extreme in my book until it got to single digits, under 10%. But I think that's going to be a tough do for oil. So 44 might be the new 10% sentiment index in oil for a while.
And it's interesting. We put together all these puzzle pieces as market participants, and you try to figure out what your plans are going to be. But a lot of times, price gets pushed one direction or another really quickly, and in these illiquid markets at extremes where you have to be willing and ready to take advantage of those quick moves if we do get them. So that's why I wanted to ask, hey, if we got a quick dip below 80, are you going to be down there on the bid? And it seems like your answer is yes. So Ken, I'll tell you what, listening to you and having this conversation with you about these specific markets, I've learned a lot. And I hope traders that are watching us on our YouTube channel and you're watching Ken, give them a thumbs up if you learned a lot here. But I want to learn a little bit more about Morrison on the markets. Tell us what you do with that.
When I came back from Asia, 5 years in Singapore and 4 years in China, moved to St. Louis, I launched in 2007 a website that looks at markets from both a fundamental and a technical analytics point of view. So I've been doing the newsletter, subscriber-based newsletter since 2007. Most of my subscribers are producers, agricultural producers, because that's my knowledge base. But I do, because the price of energy is also important to producers. So I do add oil a lot and the refined products a lot. But I write the newsletter 5 days a week. Monday through Thursday, and then on the weekend edition. So it's a daily newsletter, and I put out a daily update in the morning of any events that happened overnight. So,
wow, that's it. And I, like I said, I just learned a lot in this little bit of time. I can only imagine as a subscriber what you'd learn and how you could benefit from that. So, Ken, I want to say thank you for spending time with us on the Traders Summit community. I'd love to have you back sometime in the near future and get some updates on what you're seeing in wheat and cotton and crude, and maybe even more markets that are moving.
Okay. Loved it, Blake, and we'll do it again.
All right, Ken. Well, thanks for joining us today, and we'll be talking to you soon. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.